Sources is saying that the U.S. Treasury Department is adding 8 companies to its Chinese military industrial complex companies blacklist on Thursday.
I took buy again on gold.
Minority group known as the Uyghurs in the country's far west Xinjiang region. The companies that are on that list range from facial recognition to cloud computing, as well as to drones. 60 Chinese entities are already on that list, and U.S. investors are not allowed to take financial stakes in any of them. The UK paper also says that the Commerce Department will add another 24 Chinese companies to its entity list, restricting American companies from exporting to them. In addition, the Biden administration is considering tighter rules to limit American companies from selling to China's chip giant SMIC. So the report hit healthcare as well as tech companies out here, not only in mainland China, but also in Hong Kong. And then separately to that, the foreign ministry said today that it was very, very upset with the fact that the bill that had passed through the House does support an import ban of Xinjiang goods, and says that they're going to take countermeasures if that bill does make it through the Senate. Andrew?
Okay. Eunice, we're going to keep watching this because it feels like the drama, a new twist in the drama every single day. Eunice June, thank you very, very much. When we come back, a lot more right here on Squawk Box. Some new retail sales data. We're going to bring you the breaking numbers and instant market reaction. And then Senator Ted Cruz of Texas weighing in on Democrats' efforts to pass the Build Back Better and plan, and also the vaccine mandates, hot inflation, and so much more. A debate you are not going to want to miss right here on Squawk Box.
So we did 500 in the first trade, and this is the second trade for today.
Fed is caught in a trap. Well, there's a lot of talk that the people on the Fed, the governors and the presidents, are independent, which is a true statement. The Fed is not. The Fed as an institution was founded by the Federal Reserve Act in 1913, and it represents the government of the United States. It's part of the government. And so consequently, it wants to keep interest rates low so that America's debt isn't high, meaning the interest rates don't go higher. The other part of the trap is the inflation rate we're in right now. Look at my notes here. The PPI was up a record 9.6% in the last go-round. CPI was up 6.8%. It's the highest since 1982. I look at the average of the two, which is 8.2%, which means that unless you can make more than 8.2% through appreciation, in other words, the stock going up, or through income, which is virtually impossible in bonds right now, you're negative to real rates, and that's a huge problem. I think today's Fed meeting, is one of the most significant we've had in years.
What are they going to tell us? I mean, we know kind of what we expect to hear signaled. Is there any potential surprise out there, or anything they could say that would rattle the markets even more? I feel like the market's kind of priced in what they're anticipating hearing today, that they're going to be tapering much sooner, and that they'll raise interest rates sooner next year too.
Yeah, the Fed could come in with something that was either higher or lower, and we very well could get a surprise. There's lots of people on the Fed with different opinions right now, so it's certainly not a unanimous position that the Fed is taking. So it's going to be interesting to say who wins. But if the Fed tapers more than the market is anticipating, you could see a hit to the equity markets and a rise in yields. Though yields are so low with the 10-year Treasury around 143, even a rise of 25 or 30 basis points isn't going to make much difference in terms of the economy. I think there's a potential here for a real surprise. The Fed has also made it clear they're not going to be raising interest rates during this time period. They may be tapering, but not raising rates. So I would be shocked if they made some announcement about raising rates today. And also, I think that Chairman Powell's commentary after the FOMC minutes are released are going to be very telling in terms of not only what he says, but how he says it. It's clear that his notion that yields, that inflation was transitory was a miss. I mean, a clear miss.
Right.
It's in transit, all right. I agree it's in transit. It's in transit across the entire landscape. And we've had this huge amount of inflation, and I don't see it ending anytime soon. And by the way, with the producer price index report, that flows into the CPI, which means that the consumer price index is likely to be higher next time they announce it.
Mark, let's get back to that trap that investors are in, because if yields aren't paying you anywhere near, yields from treasuries or any of the bonds aren't paying you anywhere near inflation, this 8% plus, if you're not going to see returns on that in the stock market, those are two factors to consider, but you can't keep it in cash because that's the worst place to be in a situation like this.
Here's my suggestion, and it varies, the percentage varies with somebody's age and their income level and their lifestyle. But my suggestion is to do two things at this point. One, still have plays for appreciation. There's certainly a lot of good analysts at my firm and other firms that have good ideas. And two, I've transitioned or pivoted, if you will, out of bonds, and I'm using closed-end funds and exchange-traded funds that are yielding considerably more than the average
248, 267. So get ready to close it. 258, 272. All right, we close it with 317.